Good afternoon. Thanks for joining us for today's Money Counts webinar. I know it is a beautiful day out there, so if you've taken the time to come and listen and learn about student loans, we do appreciate that. Maybe you're tuning in from outside, and that's even better, right? We are really glad you're here because student loans are such an important topic. Today, we're going to be talking all things student loans, the borrowing process, repayment options, ways to work towards loan forgiveness, and just some general must-knows for students who are using student loans to finance their education. So if you're unsure or if you're stressed about your student loans, you've come to the right place. This will be a really informative webinar today. So before we kick it off, we've got to do some introductions here. First of all, my name is Allie Smith. I am Assistant Director of Financial Counseling here at Penn State's Sokolov-Miller Family Financial and Life Skills Center. And I am joined today by Lance. He is one of our wonderful financial literacy ambassadors. He'll be moderating the chat and posting some helpful links and resources in there throughout the webinar today. So you might want to keep the chat open. There'll actually be quite a few links coming through the chat today, just with more information on the things that we're talking about and that kind of thing. So you might want to keep that open if you don't want to miss any helpful tidbits of information. Otherwise, as you have questions, feel free to throw those in the chat or use the Q&A. Lance and I will both be looking at the chat here, and the Q&A, we'll check that out at the end. The Q&A does allow you to ask questions anonymously if you'd like to take advantage of that, if you'd be more comfortable asking questions without your name attached. Otherwise, if you're attending from Smeal's Ethical Leadership Challenge, we do have a QR code for you, and we'll share that and post it up at the end of today's webinar. All right, so those are my housekeeping items as always. Before we dive in, I would just like to take a quick minute to get to know who's in our audience today and generally how we are all navigating and feeling about our student loans. So I'm going to go ahead and launch this poll. You should hopefully be seeing it now. It's got 5 questions. I'd like to know, what's your affiliation with Penn State? So where are you coming from? If you're a student, what year are you currently? If you've taken out student loans in the past, what status your loans are currently in? And then also how you feel about your student loans. And that last question is multiple choice. So if you have multiple feelings about your student loans, feel free to check multiple boxes there. And I do realize some of these are personal questions, so just as a reminder, these are anonymous. I won't be able to see like who's saying what here, nor will anyone else in the audience. Since this is a bit of a hefty poll today, I'll give you just a minute or so to kind of work through these and let me know where you're at. So far, we have undergraduate students, staff, and Penn State parents. So good mix of folks in the audience, all people who might be thinking about their student loans, Penn State parents, maybe here on behalf of their kids, thinking about their student loans. So that's great. Welcome. We've got a good mix of students who are, in school currently, so in school deferments, some folks currently in repayment, some folks have paid their loans off, which is fantastic. Congrats. And as for feelings, I'm actually going to go ahead and end this so we can all just take a look at how we are feeling about loans together. A good mix of feelings as well. So some of us are feeling confident, grateful for the opportunities that they provide. Some of us are feeling overwhelmed, indifferent, anxious about the amounts that they owe, and some unsure of where to start. Okay, so it's good to have everyone here. Welcome. Thank you so much for sharing a little bit about yourself and where you're at with your student loans. If you have attended one of our Money Counts webinars in the past, you've likely heard me say knowledge is power before, and I truly stand by that. So I think it's true for your student loans as well, right? Generally, the more you know about your student loans, the more control and power you're going to have over them, right? So with that said, let's just go ahead and dive right in here. The first thing we have to think about in a general sense is budgeting for college. So how much am I actually going to have to pay for college, and how do I pay for college? So like, what are my financial sources to pay? Budgeting for college is a bit different than budgeting if you were working like full time in your career, because the biggest difference being that you kind of have to stretch out your money for a longer period of time, right? So instead of budgeting month to month, as you might be when you're working in your career full time, when you're budgeting for college, it's more like budgeting from semester to semester. So you've got to kind of stretch your money out, right? The first step in budgeting for college is to complete your FAFSA. FAFSA stands for Free Application for Federal Student Aid. And as the name suggests, it gives you access to federal student aid. So things like grants and scholarships from the government, and even institutional scholarships, like scholarships that you would get from Penn State, oftentimes will want to see a FAFSA on file before actually giving you that aid. So giving you that scholarship, before giving you that scholarship, they might want to see that you have a FAFSA. The FAFSA will also give you access to your federal student loans. So the FAFSA is an important piece of this puzzle that is paying for college. You'll need to fill it out each and every year to get access to financial aid. So I'm going to share out another quick poll here because I'm curious to know who has actually filled out their FAFSA. So just 2 questions. I'm curious to know, this is for students specifically, folks that do need to fill out their FAFSA. If you filled out the 23-24 FAFSA, and also if you filled out the 24-25 FAFSA. There is a box to check if you are unsure as well. Okay, it's looking like most of us have filled out the 23-24 FAFSA, which is good. And fewer of us have filled out the 24-25 FAFSA. So that could be for a few reasons. Maybe you're graduating, but if you are coming back to school in the fall for fall 2024, it is important that you fill out that FAFSA. And some of us are unsure. So this could be a good time to have conversations with the people that are helping us through this process. Maybe that's our parents. Okay. So reminder, if you have not filled out the 24-25 FAFSA, you want to be sure to do that as soon as possible. That really is where your financial aid for next fall and spring will come from, right? And if you haven't filled out the 23-24 FAFSA for this current academic year, and you need access to financial aid, maybe to pay a bill in your LionPath account, be sure to do that as soon as possible as well. The final date that you can fill in this year's FAFSA is June 30th. So that is quickly approaching here. Another important piece of the puzzle here, as you're thinking about budgeting for college and paying for college, is what is your total yearly cost of attendance? So with all things considered, how much will your education cost you per semester, per year, and in total? You can use Penn State's net price calculator or tuition schedules online to help you figure this out. Lance just posted links to both of those in the chat, the net price calculator and also different tuition schedules. And we really do encourage you to take the time to figure out what the total cost of your education will be, not only every year, but like in total for those 4 years. Factors to consider here as you're figuring out like what is the total cost of my education is if you plan to live on or maybe go off campus when you're able, and also the fact that tuition does go up for those upper division credits junior and senior year. So that's where the tuition schedule will come in handy rather than like the net price calculator, because you can kind of see the difference there between those lower division credits and upper division credits, and how much extra you'll need to plan for those potentially last 2 years of your education. Once you've kind of figured out how much you'll need to pay for college each year, it's time to consider your financial sources to pay that bill and really make a plan. We always want to start with grants and scholarships. Remember that we are considered for federal and state grants and scholarships just by filling out the FAFSA. But there are additional ways to get scholarships. So don't stop here. Don't stop with just filling out the FAFSA and calling it a day. Your academic college is really a great place to search for scholarships. Some colleges have a single scholarship application, and when you fill that out, you'll be considered for all the scholarships that you're eligible for in your college. Other colleges have different scholarships that you'll need to kind of like apply for each individually. But in any case, we did post a link to Penn State's scholarship page. And this is just like a hub of places to find scholarships around Penn State. On this page, you can also click a link for academic college scholarships, and that will take you to a whole list of all the academic colleges and their different scholarships that they offer. So find yours and be sure to apply for those. Work study is another source of financial aid that you might consider. If you're interested in work study, you'll need to indicate that when you fill out the FAFSA. So there'll be a box to check there. And just because you check that box on the FAFSA doesn't mean that you have to get a work study job or that you're required to. It just gives you the ability to if you're eligible. Work study aside, finding a part-time job on or off campus can help you offset some of your education costs. So if you're able to successfully work part-time while also successfully getting your education and studying, it's not a bad idea to do so. Then you'll want to use any personal funds that you have saved for college, so money that you or your family has earmarked for college and education expenses. And then finally, student loans. Notice that loans are at the bottom of this list here because we really encourage you to focus on some of these other sources first before turning to student loans. So since this presentation is all about student loans, what steps should we take before borrowing loans? Hopefully we know this already because we just talked about it, right? But the very first step is to complete the FAFSA. You'll want to do this each and every year. And again, it will give you access to federal and state free money, so those grants and scholarships, and also your federal student loans. If you are going to be borrowing student loans to pay for your education, filling out the FAFSA is an essential step. Typically, the FAFSA opens October 1st of each year for the following fall. But as I'm sure most of us know, this year was a bit different and the 24-25 FAFSA came out late. It is open now, so if you haven't done that yet, be sure to get that done as soon as you can. But moving forward, the FAFSA will open again on October 1st. So we'll kind of revert to that old date that we had. So be on the lookout for that in the future. Generally, you want to submit it as early as you can because some sources of aid are kind of first come, first serve. Here is the time before you borrow loans where you'll also want to be talking with your family. This is a great time to have a family financial meeting. And here is really where you should be figuring out the total cost of college and how it will be paid for. You can factor in any family financial support that you may have, but it's important to know what that looks like first, right? Oftentimes, working with students a lot in the one-on-one space, I see oftentimes parents will kind of take the lead in figuring out how to pay for college. They'll sign their students up for loans, thinking that they're being really helpful and getting things done and just getting the ball rolling and simplifying the process. But in reality, the student really does need to be involved in this process and in these conversations. I think the worst thing really that parents can do is kind of do it all for their students, because then the students themselves are really clueless as to if they have student loan debt or not. So for you Penn State parents, be sure to involve your students in these conversations. Really, generally, this is a good time to talk through what are the parents' financial responsibilities that they're willing to take on to help the student, and what are the student's financial responsibilities as well. So if you are going to be borrowing money, who is going to be taking on that debt? Will it be strictly the student, or are parents willing to help? And then just finding as much free money as you can. So when we say free money, this is really, again, those grants and scholarships that can be used to help with the cost of your education and don't need to be repaid. So free money because it doesn't need to be repaid and you can put it towards your education. So really look within Penn State first for these scholarships and grants and free money. Um, in your academic college is a great place. I also see a lot of students getting money from their home communities, especially like first and second year. So places like YMCAs, Rotary clubs, civic organizations, churches maybe, or other random scholarships that you might find in your community at home. Look out for those and just be sure to apply for any that you see that you're eligible for. From there, you can utilize some of these other scholarship hubs that Lance posted in the chat earlier. So like FastWeb, Career One Stop is also the Department of Labor. So they have scholarships as well. And Unigo are all some ones that Penn State's Office of Student Aid kind of suggests students to check out. Generally, it's a good idea to set a few hours a week aside to apply for scholarships. And the goal here really is to minimize the amount that you do have to borrow as much as possible. If student loans do end up being a piece of the puzzle, then you've really got to figure out how loans work, what type of loans to take, and how much you need. Student loans fall into two categories. There are federal student loans and private student loans. We always want to start by taking our own federal loans for the following reasons. They are government issued. Generally, they have lower interest rates. As part of your financial aid package, you may receive some subsidized loans, which don't accrue any interest as long as you're enrolled in school at least half time. Your unsubsidized loans will accrue interest as any other loans would. So it's important to be aware of which types of loans you're being offered, and if you already have student loans, which types that you have. You may have a mix of both subsidized and unsubsidized loans. Federal loans don't require a credit check. You get access to these loans by filling out the FAFSA. And as long as you've filled out the FAFSA and meet the academic requirements, which we'll talk about later, these federal loans are offered to you automatically and you can accept them in LionPath. Federal student loans are also typically more flexible on repayment because they offer things like income-driven repayment plans, and they're also eligible for loan forgiveness programs. Private loans are a bit harder to speak on since they come from banks and each bank is going to have its own terms. But generally, private loans tend to have higher interest rates. They're not subsidized, so they begin accruing interest immediately. They do require a credit check and oftentimes a cosigner as well. And they don't typically offer any sort of forgiveness programs or income-driven repayment plans. So with that said, we always want to start with our federal loans. Let's take a quick look here at the different types of federal student loans. First of all of these different types of federal student loans will have fixed interest rates. What the rate is determined annually and it's tied to the Fed rate. So you'll likely have a different rate year to year, but once you've taken your loans out at a certain rate, that rate is set for the life of the loan. So for example, I'm meeting with folks right now who are graduating and they have loans from their first and second years that are around like 3%, really low interest. And then the loans that they're taking out this year for their last year are at 5.5%. And this is just because the interest rate environment was low a few years ago, and it's kind of increased in more recent years. Okay, so for taking a look at this visual here, for undergraduate students, we have subsidized and unsubsidized federal student loans. The amount of subsidized loans that you receive as an undergraduate student will be based on financial need shown in your FAFSA. Graduate and professional students can also access unsubsidized loans. And when students are enrolled at least half-time, payments on their direct subsidized and unsubsidized loans will be deferred, meaning that no payments will be required on those loans as long as students are enrolled at least half-time. It's important to note, though, that interest will accrue on those unsubsidized loans. For both subsidized and unsubsidized loans for both graduate and undergraduate students, there is a limit that you can borrow each year. So you can't just borrow from federal student loans or like your own federal student loans, whatever amount that you need to cover your bill. And the idea of the fact that you might have a gap in paying your bill is where PLUS loans can come in. There are Parent PLUS loans and Graduate PLUS loans. The annual limit for these loans is the cost of attendance minus any other financial aid. So let's look a bit more into Parent PLUS loans here. Parent PLUS loans are loans that the parents agree to take on behalf of their kids' education. Parent PLUS loans are available to biological or adoptive parents of dependent undergraduate students who are enrolled at least half-time. It's important to note here and just clarify that Parent PLUS loans are not loans in the student's name. So students are not legally or technically obligated to repay Parent PLUS loans. It doesn't show up on their credit report. They're not associated with those loans in any way other than the fact that the loans were taken out to help pay for their education. I do see sometimes, though, that parents will agree to take on Parent PLUS loans with the understanding that their student will help pay them back once they graduate and go into the workforce, but this is not required, right? So it's important to talk about these types of expectations in your family financial meeting. Can't stress that enough. Parent PLUS loans do require a credit check, unlike the subsidized and unsubsidized federal student loans. And if Parent PLUS loans are denied due to adverse credit history, parents can obtain a cosigner or an endorser or provide documentation explaining can I say this word today? No, extenuating circumstances. I still don't think I said it right. They can do these things to try and be approved. To obtain Parent PLUS loans, parents will need to complete the FAFSA. Parents can borrow up to the cost of attendance minus any other financial aid the student is receiving. It is important to note that you should only borrow what you absolutely need, and you can actually indicate when you borrow money the exact amount that you need. And this is true for all of the loans. So we'll talk about loan limits for undergraduate loans a little bit later. If you don't need to borrow all of those, you shouldn't. You don't have to, right? You really should only borrow the amount that you need. For Parent PLUS loans, you can request a deferment. So when you're in deferment, payments won't be due until the student graduates. However, interest will accrue during that time of deferment. And of course, Parent PLUS loans are federal loans, so income-driven repayment and forgiveness is possible on Parent PLUS loans. This is just like a quick kind of crash course on Parent PLUS loans. So if you are thinking about Parent PLUS loans, considering Parent PLUS loans, Lance put a link in the chat with more information directly from Student Aid on Parent PLUS loans. I guess I'll just say that Parent Plus loans and private loans both give you the ability to borrow up to the cost of attendance and really fill a gap that isn't covered by financial aid or the student's own federal loans. It is a good idea to compare your options with Parent Plus loans and private loans to see what's going to be the better option for you. And this is really going to vary person to person. So, for example, maybe parents don't want to take on debt solely in their name on behalf of their student. And in that case, private loans might be the best option. On the other hand, maybe the parent works in public service and these potential Parent Plus loans could benefit from the public service loan forgiveness program and income driven repayment. So then in that case, Parent Plus loans might be the best option, right? And there are other considerations, of course. And if you're in the space where you're thinking about this and trying to decide between the two, you'll really have to do some research to figure out what is going to be the best option for you and your situation. Okay, so let's talk more about loan limits here. Generally speaking, there are two types of loan limits that will affect student borrowers. There are annual loan limits and aggregate loan limits, and we'll talk about each. The annual loan limit is how much can be borrowed each year, and the amount will differ based on what credit year you are. So, first year, second year, third year, um, and what type of student you are. So check out these annual limits on the screen here. A first year student can borrow 5,500 of their own federal loans. A second year student can borrow 6,500, and a third or higher year student can borrow 7,500. To clarify, these are for dependent students, these amounts that I'm reading off here. And this is an annual limit. So if you're a first year student and you get $5,500 in your own federal student loans, subsidized and unsubsidized, that amount will be split between fall semester and spring semester. Independent students can borrow between 4,000 to 5,000 more per year, depending on which year they are in their own federal loans. So to be clear, an independent student has some very specific requirements. You can't just decide that because your parents aren't doing much to help pay for the cost of your education, that you're an independent student, right? An independent student is one of the following: at least 24 years old, married, a graduate or professional student, a veteran, a member of the armed forces, an orphan, ward of the court, someone with legal dependents other than a spouse, an emancipated minor, or someone who is homeless or at risk of becoming homeless. There is a link in the chat. Lance just put that in there with more on who's considered an independent student, and it'll kind of help you walk through the process to decide, am I an independent student? Students whose parents have received a denial for Parent Plus loans will be treated for purposes of annual loan limits as an independent student. So students whose parents have received a Parent Plus loan denial will be offered in that year the amount under the independent student category. Okay, and then the aggregate limit is the total amount of money you're able to borrow over the course of your education. So for a dependent undergraduate student, the aggregate limit, the amount that they're able to borrow in their own federal student loans, is $31,000. And for an independent student, this number is $57,500. The important kind of takeaway here with aggregate limits is that if the total amount you've received over the course of your education reaches this limit, you won't be able to receive any more federal student loans in your name. Graduate students can receive $20,500 annually, and then graduate students' aggregate limit or lifetime limit is $138,500. And this includes anything that they've borrowed in their undergraduate career as well. For Parent Plus loans or Graduate Plus loans, the limit is the cost of attendance minus what you or the student has received already in financial aid. And there's no aggregate limit for PLUS loans. So the cost of attendance really is the cost of everything related to getting an education. So tuition, room and board, books, transportation, everything. It is determined, this number specifically is determined by the university each year. So it's really, again, important to note here that you should only borrow what you need, and you really might not need to borrow up to the cost of attendance. Okay, so when borrowing federal aid, it's important to be aware of satisfactory academic progress and how it can affect you and your student aid and really your ability to pay for college. Satisfactory academic progress is the process used by financial aid to determine if a student is meeting all of their educational requirements and is on target to graduate on time with a degree or certificate. You have to keep satisfactory academic progress to avoid losing your federal student aid. So to keep satisfactory academic progress, you have to maintain a GPA of 2.0 and above for your undergraduate career and 3.0 and above for your graduate career. You also need to pass and finish at least 67% of the classes that you start and finish your degree in the allotted amount of time. So this is really something to consider if you're thinking of late dropping a class, right? You need to make sure that you're still going to be in good standing with your satisfactory academic progress and your financial aid before making that decision. So the Office of Student Aid and your academic advisor can help you figure this out. So what can we do here to be sure that we're maintaining satisfactory academic progress? You can meet with your academic advisor regularly, again, especially before dropping a class. You can utilize academic resources to help you pass the classes that you start. And of course, look out for any and all emails from the Office of Student Aid because they're probably important. They'll notify you if you're not meeting satisfactory academic progress or if you're getting close to your aggregate loan limit, which means that you're running out of your own federal loans to borrow, right? Okay, so the first half of this webinar here, we focused on borrowing student loans and kind of what that process looks like, things to be aware of. And now let's talk about repayment and various ways to get rid of your student loans. This is the big question, right? How do we get rid of these things? So generally, there are 4 ways to get rid of your student loans. You can repay them, you can work towards forgiveness, they can be discharged, or they can be canceled. Most folks will get rid of their loans by repaying them. During repayment, the borrower will repay their loans through one of the many repayment plans, and we'll explore those repayment plans more closely in a few slides. You are actually able to ask your employer if they can assist you in student loan repayment also. I've met with some graduating seniors whose employers have agreed to pay off some of their student loans as part of their benefits package, which is great. So we'll explore repayment in more depth a little bit later, but there's also forgiveness, and there are a few different types of forgiveness. And to clarify here, when we talk about these options, repayment, forgiveness, discharge, and cancellation, we really right now are talking about federal student loans. So these forgiveness programs only exist on federal student loans. Public service loan forgiveness is potentially the most popular type of federal student loan forgiveness. This program kind of serves as incentive in a way to work in the public sector. To qualify for public service loan forgiveness, you have to make 10 years of qualifying payments under an income-driven repayment plan while working for a qualifying employer, so one that is in the public sector. And then generally the remaining balance on your loans after your 10 years of qualifying payments will be forgiven. Teacher loan forgiveness is for teachers, as the name suggests. This program forgives a set amount for teaching at an eligible school. Teacher loan forgiveness provides either $5,000 or $17,500 in loan forgiveness for teachers. Secondary level math or science teachers and special education teachers are eligible for the larger amount, so the $17,500. Perkins loan forgiveness deals specifically with the Perkins loan program. Perkins loan program disbursements have since ended, I believe in 2017. So the use of this program will likely become more rare as those loans kind of phase out. And then there's also income-driven repayment forgiveness. And under IDR forgiveness, any remaining balance is forgiven if loans aren't fully repaid by the end of the repayment period. So this is either at the end of 20 years of repayment or 25 years of repayment, depending on the types of loans that you have and the repayment plan that you're in. These various types of these various types of forgiveness programs can be a bit confusing. So if you think you might be eligible to pursue one of these forgiveness programs, we do encourage you to make an appointment with us and we can help you work through the details. We do work with a lot of people regarding public service loan forgiveness. So we're definitely open to talking with you about that if that's something that you're thinking that you might be eligible for. Loans may also be discharged. If this happens, you don't have to pay the remaining balance on your loans in most cases. I used to joke and say that the only way your student loans can go away is if you die. And, that's true, right? Student loan debt doesn't pass on if the borrower passes away. Loans may also be discharged in the case of disability that prevents you from earning money for more than 5 years, or disability that will ultimately result in death. Loans can be discharged if you file for bankruptcy and file an additional adversary proceeding, but student loan discharge in bankruptcy does not happen automatically. There's more work involved and it's more complicated than just filing for bankruptcy. So if student loan debt is your only debt, you might want to think twice about bankruptcy because we're not really guaranteed that it will go away when you file for bankruptcy. There is also borrower defense discharge, and this is for borrowers who were defrauded by their schools or if their schools closed before they could finish their degree. In most cases, you do need to apply for this. It doesn't always happen automatically. And then there is a forgery discharge as well. And this can occur if forgery by your school is discovered. Lastly, we have cancellation. The borrower defense to repayment is a cancellation program for borrowers whose schools violated certain laws or defrauded or misled students. And then, of course, there was the attempt from the Biden-Harris administration in 2022 to cancel between $10,000 and $20,000 for borrowers. And as we know, this unfortunately did not happen. So looking at these options here, generally, most folks will repay their loans. Some will get them forgiven through programs like public service loan forgiveness or teacher loan forgiveness, and discharge and loan cancellation are definitely out of these the least common ways to get rid of your student loans. Okay, so when it comes to repayment, what are some terms that we need to know? First of all, the grace period is the period directly after you graduate. Your loan servicer, the federal government, will give you 6 months for your federal student loans before they want you to start repaying them officially. So you have 6 months once you graduate to really get on your feet, find a job, get settled in with your financial life, and then you'll be required to sign up for a repayment plan and start loan repayment. This is for 6 months, and during this time, interest will continue to not accrue on your subsidized loans. So that's a nice perk of this grace period and having those subsidized loans. Interest will, of course, accrue on your unsubsidized loans. It's also important to know who is your federal loan servicer. You took your loans from the government, right? But you don't pay them back directly to the government. The government has hired out these companies called loan servicers that handle billing, and that's who you'll actually make your payments to, is your loan servicer. You can find who your servicer is online by logging into your account at studentaid.gov. If you look at your dashboard and look towards the right side, you'll see clearly link. Here is my loan servicer, and here's a link. And then it's also important that you know that your repayment plan for your federal student loans can be changed at any time for free. The loan simulator is a great tool. It's on studentaid.gov, and it can help you estimate repayment options with your information in mind. So like your income, your loan balance, your interest rates, all of that good stuff, it can spit out. Here are your estimated payments under these different repayment plans available. So more on your loan servicer here. As soon as you get your first federal student loan, you will have a loan servicer. And everyone who has federal student loans, even those who aren't in repayment right now, should really know who their loan servicer is. Again, if you're unsure, you can go to studentaid.gov and view your dashboard, and you'll see it on the right side there. And this is who you'll actually make payments to. The loan servicers are on the screen here. So your loan servicer should be one of these. And of course, you'll want to beware of scammers disguised as your loan servicer. A few ways that you can avoid scams when it comes to your federal student loans and your loan servicer include being sure to never share your FSA ID or studentaid.gov login information with anyone. Saving your loan servicer's email and marking it as important so you can see information coming from them. And you'll want to be aware of any fake emails that might look like they're coming from your loan servicer, but actually are not. And since we're talking scams here, just a quick reminder that you should never need to pay to get help with your federal student loans. Studentaid.gov and your loan servicer can help you with your federal student loans for free. Okay, so let's look a bit more closely at the different repayment plans that exist for you to choose from after graduation. And again, to clarify, these are for federal student loans, right? The standard plan is the kind of default plan. If you use up your 6-month grace period and don't make a decision for your repayment plan, you'll be thrown into the standard plan. This plan sets a monthly payment amount that will pay off your loans in 10 years. So basically equal monthly payments every month for 10 years. And at the end of 10 years, you'll have them paid off. The amount that you pay under something like the standard plan, the graduated plan, and the extended versions of these two plans are really based on the amount that you owe and paying your loans off, right? If you have a higher loan balance or a lower salary out of college, payments under these, like I want to pay my loans off in a set number of years, might not be super affordable, right? To kind of touch on the other options here, the graduated plan will also allow you to pay off your loans in 10 years, but your payments will start a bit lower, and those payments will increase every 2 years over that 10-year repayment period. So this could be a good option maybe for someone who has a lower starting salary right out of college, but knows they'll be making a bit more later on. And then there are also extended options for both the standard and the graduated plan, where the time to repay can be stretched from 10 years up to 25 years. To qualify for an extended plan, you have to have more than $30,000 in outstanding direct loans. So, an option like the extended plan can help keep your monthly payments lower, but remember, the longer you stretch out repayment, the more interest you'll pay over the life of the loan. Okay, so again, the options in this red box here will repay your loans in a set number of years. There are also income-driven repayment plans where your payment isn't based on the amount that you owe, but rather your income. So they consider your income and your family size. Income-based plans aim to ensure that you have an affordable payment, which is really a positive thing. But under an income-driven plan, you might not be making as much progress on your loan balance as you want to be making. So this is something to be aware of if you enroll into an income-driven plan. Generally, with income-driven plans, your payment is based on your income, right? Not your loan balance. So if you are making a payment that is less than the amount of interest that's accruing on your loans each month, your loans could be growing depending on which income-driven payment plan that you're in. The SAVE plan, which is the first available option in this green box here, is the new repayment plan, the new income-driven repayment plan. And it works differently than all of the old income-driven repayment plans of the past. So the SAVE plan has this feature that says, if you make a payment that does not cover the amount of interest that's accruing on your loans each month, that additional interest will be waived, subsidized, basically. So under the SAVE plan, as long as you're making the payments that are required of you, your balance is not going to grow. So this is really a new thing in the income-driven repayment plan landscape. All of the other repayment plans that you see on the screen here don't work in that way. So if you make a payment where your amount that you're paying is not reaching the interest that's accruing on your loans each month, your balance could be increasing. So these are things to be aware of, right? This is really important information. Each of these income-driven repayment plans all have different formulas to kind of help you determine what your monthly payment will be. And again, they consider your income and your family size. Typically, these plans each have a set amount of time that you'll make payments. Usually it's 20 or 25 years, and then the remainder of what's left after you've paid for that set amount of time is forgiven. So 20 or 25 years, depending on the plan that you're enrolled into and the types of loans that you have. And really the takeaway here is that there are options, right? There are a lot of options for federal student loan repayment. Different options that might work for different times in your life, different situations, and hopefully you can work these kind of into your long-term financial plan and your budget. When it comes to repayment, it's really important to pay the amount that's due on your bill and to pay by the due date. And of course, if you are enrolled into a plan that's unaffordable, you can change that up at any time for free. The loan simulator is really a great tool that is good for everyone to use. So if you're still in school and you're not done borrowing, you can use this tool to help you simulate borrowing more and figuring out how many loans am I really going to be graduating with here. And if you are graduating soon, you can use this tool to help you figure out what is the best repayment option for me when I graduate and enter repayment. This is really a great tool. I use it all the time in one-on-one appointments. So if you log in, you'll have to log in. If you log in, you can use this tool to put in all of your information. So your loan balances, your interest rates. You can also put in your income or your future estimated income. and it'll show you estimated dollar amounts for your situation and each of those repayment options. So really a great tool to help you clearly see all of your options and what might be best for you depending on what your goal with your loans are. Like if you want to pay them off super quickly to pay the least amount of interest over time, they can help you figure out how to do that. Or if maybe you want to pursue something like public service loan forgiveness and you're trying to figure out what's the best income driven repayment plan for me and under which of these will I pay the least, you can use it for that too. So, really a great tool. I do believe there is a link in the chat here for the loan simulator, but you can also scan this QR code if it's easier to check it out on your phone. Okay, so I will say federal student loan repayment is flexible enough with things like income-driven repayment and options for deferment and forbearance, that hopefully we can make these payments or at least like stay in good standing with our loan servicers. If not, you're considered to be in default if you don't make your scheduled student loan payments for 270 days. So these are some of the things that could happen if you go into default. You could lose eligibility for additional federal student aid. This default will be reported to the credit bureau, so this will have an effect on your credit score. Tax refunds and federal benefit payments could be withheld. Your wages could be garnished. Court action could be taken against you, and then you might be on the hook to pay for those court costs, collection fees, attorney fees, and other costs associated with the debt collections process. So this is not really a place that we want to find ourselves in, right? If you do have a defaulted loan or find yourself in the future with a defaulted loan, you can take corrective action by rehabilitating your loan or consolidating your loan. So take a look here just at the differences between each of these options. Once you've got your loan back in good standing, here are some of the benefits that you're eligible for under each of these programs. So they both offer eligibility for deferment, eligibility for forbearance, choice of your own repayment plan, eligibility for those loan forgiveness programs, and eligibility to receive future financial aid. Where these differ is that the rehabilitation program offers to remove that record of default from your credit history and your credit report, and no interest or collection costs are going to be capitalizing on this loan during this time. Consolidation does not offer those benefits, so that's something to be aware of. To start the loan rehabilitation process, you have to contact your loan holder. And to consolidate your federal student loan and get a consolidation loan, which will ultimately be the corrective action that you need to get this benefit, you have to agree to repay the new consolidation loan under an income-driven plan or make 3 consecutive on-time payments on the defaulted loan before you can consolidate. Okay, that was a lot of info. A lot of information, right? If you are still tracking here, I would love to see in the chat what is the most important piece of information or tip for student loans that you learned today. Like we covered the whole scope, right? Borrowing loans, things to do before you borrow, repayment, what happens if you go into default, the whole 9 yards. So as you're thinking about that, please share it out in the chat. We also want you to know that we are here to provide education and support when it comes to your loans and just your general financial wellness as well. We do offer one-on-one appointments, and students can schedule those through Starfish to, talk through their financial questions and get personalized education and guidance from me or one of our other one-on-one coaching providers. We do specifically also meet with faculty, staff, and alumni regarding public service loan forgiveness. So if you have questions about public service loan forgiveness and your eligibility for that, please reach out to us. You can email us at finlit@psu.edu. Otherwise, we have linked a lot of good information coming through the chat here, like how you can get connected with us. All of our webinars are recorded. So if you want to rewatch today's webinar, it'll be recorded on our YouTube, recorded and posted on our YouTube page in the next few days. There is a link to our YouTube page in the chat. And then also our student loans self-study module is linked in the chat as well. You can check out any of our other services or resources by scanning this QR code on the screen or going to our website, financialliteracy.psu.edu. Okay, so thank you for tuning in today. I hope this was helpful in kind of understanding student loans more.